What if criminals could steal $25 million with nothing but a video call? Here's the terrifying part. It already happened. Every executive on that video call, AI generated deepfakes. Every single one. Could your compliance team have spotted the difference? In 2025, this isn't science fiction. It's the new reality of financial crime. And if your compliance program isn't adapting, you're already behind. Today, I'm breaking down the three seismic shifts reshaping financial crime in 2025 and what you absolutely need to know about 2026. We're covering beneficial ownership transparency, the AI arms race in compliance, and the explosion of digital identity fraud. Plus, I'll reveal why regulators just increased penalties by 417%. Let's get into it. The financial crime landscape in 2025 has fundamentally changed. And whether you're ready or not, three parallel forces are about to collide, and your compliance program is caught in the middle. First, regulatory fragmentation, where beneficial ownership rules are diverging dramatically between jurisdictions. Second, technological acceleration, where AI driven attacks and defenses are evolving faster than anyone predicted. And third, supervisory intensification, record enforcement actions, and new effectiveness standards that could put your program under the microscope. Global regulatory penalties exceeded $1.23 billion in just the first half of 2025. That's a 417% increase from last year. And these aren't just big bank problems. Mid-size institutions are getting hit too. The message from regulators is unmistakable. The era of compliance theater is over. So, what's actually changing? I'm about to show you a regulatory reversal that exempted 32 million companies overnight. But first, let me warn you, what's happening in Europe will completely change how you verify identity by 2026. Let's start with beneficial ownership transparency. And here's where things get really interesting because the US and Europe are moving in completely opposite directions. In March 2025, the United States made a historic reversal. FinCEN, that's the Financial Crimes Enforcement Network, issued a rule that eliminated beneficial ownership reporting requirements for all US created entities. Let that sink in. 32 million domestic companies that were expected to file beneficial ownership information with FinCEN are now exempt. The Corporate Transparency Act, originally designed to create comprehensive beneficial ownership visibility, has been fundamentally recalibrated. The rule now applies only to foreign reporting companies registering to do business in the United States. That's approximately 12,000 entities, down from 32 million. But here's what compliance professionals need to understand right now. This doesn't change your customer due diligence obligations. The rules requiring you to collect beneficial ownership at account opening, the 2016 CDD rule, is still fully in effect. You still need to collect beneficial ownership information at account opening. What's changed is that FinCEN's BOI database won't be a centralized verification resource for domestic entities anymore. So, what should you do? Discontinue FinCEN BOI database lookups for domestic entities, but strengthen your internal CDD processes. They're now your primary beneficial ownership verification mechanism. Now, here's where it gets interesting for global institutions. While the US just eliminated requirements for 32 million companies, the EU is about to mandate digital identity wallets for every citizen, and this will fundamentally change your KYC process. The EIDAS 2.0 regulation, that's the EU's electronic identification law, establishes a European digital identity framework with mandatory digital identity wallets. This is a paradigm shift. By 2026, every EU member state must make available at least one interoperable European digital identity wallet to citizens and businesses. These wallets will allow citizens and businesses to link national digital identities with additional personal attributes, driving licenses, qualifications, bank accounts, all in one secure, user controlled system. Users will be able to prove their identity and share documents without unnecessary personal data disclosure. Its selective attribute sharing meets unified security standards. The target: 80% of EU citizens and businesses actively using these wallets by 2030. For financial institutions, this means digital identity wallets will become a primary mechanism for KYC verification. Digital identity wallets will displace legacy document based onboarding, fundamentally changing how beneficial ownership identification works. For multinational institutions, this divergence creates operational complexity. You'll need dual compliance frameworks, minimal domestic BOI reporting in the US, while preparing for comprehensive digital identity integration in the EU. And keep watching the US landscape. The Treasury Department is still accepting comments on the interim rule, and CTA litigation continues in multiple jurisdictions. Policy reversals in future administrations are possible. Build that contingency into your planning. But beneficial ownership is just the beginning. Coming up, I'll show you how criminals stole 25 million using deepfakes and the 5 AI attack methods your team needs to know about right now. Now, let's talk about what I consider the most transformative and dangerous trend of 2025, the AI arms race in financial crime. Here's where we are right now. Only 28% of organizations currently use AI in their AML processes. But here's the critical number. Nearly 50% plan to implement AI-driven solutions in 2025, particularly in transaction monitoring and sanction screening. 75% of AML professionals now prioritize compliance efficiency, with AI-driven automation as their primary tool to reduce manual workloads. And over 50% of organizations now complete sanctions and watchlist screening in real time. That's a massive shift from where we were even 2 years ago. But here's what keeps compliance officers up at night. Criminals are weaponizing the exact same technology. Remember that $25 million deepfake video call I mentioned at the start? That was real. An employee at engineering firm Arup authorized that transfer after a video conference where every executive on screen were AI-generated deepfakes. This is just one attack vector. Let me walk you through the 5 ways criminals are using AI right now. First, hyper-personalized phishing. Criminals use AI to scrape personal information from social media and company websites, then feed this data into language models to create messages referencing actual events and colleagues. Second, synthetic identity fraud. AI creates fake profiles using both real and invented data that pass verification processes, open accounts, receive credit, and then default, leaving no trace of a real person. This has increased by 378%. Third, behavioral mimicry. Criminals train models on real transaction data to replicate typical customer behavior, timing transfers to payday patterns, splitting illegal transfers into amounts that mirror regular vendor payments. Fourth, rapid crypto laundering. AI accelerates fund movement across dozens of cryptocurrency wallets, executes obfuscation tools, converts assets across chains, and re enters funds into fiat, all in seconds. And fifth, real-time deepfake conferencing. Unlike pre-rendered videos, these enable fraudsters to actively impersonate individuals during live interactions, improvising and adapting in real time. So, how are institutions fighting back? The answer is governance, explainability, and human oversight. First, audit trail transparency. Leading platforms now embed audit log panels directly into investigation workflows, allowing compliance teams to export case histories and demonstrate consistent processing. Second, human in the loop decision making. AI is deployed to support investigators, not replace them, summarizing reports, flagging inconsistencies, visualizing money flows, generating draft SARs. But final determinations remain with trained investigators. Third, configurable risk models. Monitoring systems must allow risk teams to adjust detection thresholds and introduce new typologies directly without lengthy development cycles. This enables rapid response to emerging threats. And this isn't optional. Regulators are demanding explainability by law. The EU's AI Act combined with banking supervision makes explainability and model governance legal requirements. FinCEN's notice of proposed rulemaking explicitly mandates that institutions can explain how any AI model flagged a transaction, what data contributed to the alert, and which steps were taken by both AI and human investigators. Looking ahead to 2026, expect 3 major developments. First, agentic AI maturation. Systems marketed as agents will face greater pressure to demonstrate they're not acting autonomously in ways that can't be explained. Second, AI governance becomes competitive advantage. Institutions that demonstrate measurable gains while clearly explaining tool functionality will be better positioned in regulatory examinations, and regulators are using AI analytics themselves now. The Bank for International Settlements deployed an AI-driven supervisory toolkit in April 2025. Your supervisors now have advanced detection tools too. Third, crypto and cross-channel convergence. By 2026, blockchain analytics will be standard AML components. But here's what I haven't told you yet. The most urgent threat isn't AI-powered attacks. It's what's happening with digital identity. 1 in 20 verification failures are now deepfakes. Let me show you exactly what we're dealing with. Now we arrive at what I believe is the most urgent threat facing financial institutions, the digital identity crisis. Here are the numbers that should concern every compliance professional. 1 in 20 identity verification failures are now linked to deepfakes. Global fraud attempts grew by 21% year over year, with deepfakes driving a significant portion of IDV failures. There's been a 46% increase in adversary in the middle attacks, many executed as real time deepfakes. And some regions are experiencing 900% increases in AI generated deepfakes. This isn't a future problem. This is happening now. Let me show you exactly what we're dealing with. Unlike pre rendered synthetic videos, real time deepfakes enable fraudsters to actively impersonate individuals during live interactions. Investigative reporting has revealed sophisticated tools in active use. Deepface Live, Magicum, and Amigo AI allow fraudsters to alter face, voice, gender, and race during live video calls. A fraudster can mimic a government issued ID, then instantly match their manipulated appearance on camera, deceiving systems that rely on photo to selfie comparisons. Cybersecurity firms including Centilink and Reality Defender confirm that real time deepfake attacks are actively targeting onboarding systems in banking, fintech, and crypto. And it gets worse. Generative AI tools have democratized the creation of hyper realistic identity documents. Fraudsters can forge driver's licenses and government IDs without manual photo editing. The barrier to entry for identity fraud has essentially collapsed. What once required sophisticated technical skills now requires access to commercially available AI tools. So, what's working? Organizations are moving beyond static document verification to behavioral and biometric multilayering. First, AI powered liveness detection, systems trained on adversarial samples to detect manipulated video characteristics, looking for the subtle artifacts that deepfakes produce. Second, behavioral anomaly detection, flagging unusual user device interaction patterns that might indicate the person on screen isn't who they claim to be. Third, link analysis, identifying repeat attackers using synthetic identities by tracking connections between fraudulent applications. And video KYC with biometric verification is becoming the gold standard for 2026. Simple document uploads are no longer sufficient for remote onboarding. Looking ahead to 2026, biometric liveness with multimodal verification, combining face and voice, will be critical to preventing fraudulent account openings. And the smartest institutions will shift risk detection upstream into onboarding. But here's what will really determine who wins and loses in 2026. Regulators have completely changed what they're looking for. Forget checkbox compliance. Let me show you the new standard. Now, let's talk about what regulators actually want. 2026 marks a definitive pivot from technical compliance to demonstrable effectiveness. FinCEN's notice of proposed rulemaking mandates that AML programs be, and I'm quoting here, effective, risk based, and reasonably designed to produce highly useful information for law enforcement. This is a fundamental shift. Static, periodic risk assessments are obsolete. You need dynamic, continuous risk scoring that links specific threats to specific controls. Examiners will assess whether your program effectively mitigates institution specific risks, not whether it exists on paper. The enforcement actions prove this isn't just guidance. Barclays was fined £39.3 million for weakness in monitoring high risk corporate clients despite multiple red flags. They allowed £46.8 million in criminal funds to pass through their systems. In Europe, the EU's Anti Money Laundering Authority, AMLA, formally began operations on July 1, 2025, establishing headquarters in Frankfurt. In its first weeks, AMLA signaled that firms engaging in crypto asset activities must have strong protections against money laundering and terrorist financing. Direct supervision of relevant entities will commence in 2028. This represents a transformational shift in European AML governance. And here's a challenge forcing operational transformation: the EU Instant Payments Regulation. Payment service providers must receive instant euro payments from January 2026. Institutions face supervisory pressure for inflow interdiction on high risk corridors rather than next day detection. You're being forced to make compliance decisions in milliseconds. So, what should you actually do? Let me give you the critical action items across all three trends. For beneficial ownership, if you're US focused, discontinue FinCEN Boy database validation and strengthen internal CDD processes. For EU operations, begin planning for EIDAS 2.0 wallet integration now. For AI and machine learning, embed auditability, explainability, and human oversight into every AI deployment. Invest in model governance frameworks capable of withstanding regulatory scrutiny. For digital identity, transition from static document verification to real-time biometric liveness detection. Implement multimodal biometrics, face plus voice, to counter sophisticated deepfake attacks. Here's the strategic framework that ties this all together. Build real-time and batch processing layers capable of sub-100 millisecond screening for instant payments. Integrate fraud, AML, sanctions, and digital asset risk oversight into unified financial crime platforms. Develop regional compliance configurations that adapt to divergent regulatory expectations. Most importantly, shift risk assessment upstream. Detect risks at the earliest lifecycle points. Integrate intelligence signals into initial decisioning. This is where the competitive advantage lies in 2026. Let me leave you with this. The compliance professionals who thrive in 2026 won't be the ones with the biggest budgets or the fanciest tools. They'll be the ones who saw these shifts coming and positioned their teams to lead, not follow. That can be you. They'll deploy explainable, auditable AI. They'll integrate identity verification with biometric rigor. They'll operate at real time processing speeds, and they'll structure risk assessments around emerging threats. The financial crime landscape has transformed. The question isn't if your compliance program will face these challenges, it's whether you'll be ready when they hit. And based on the deadlines we just covered, that moment is closer than you think. If you found this breakdown valuable, make sure to share it with your compliance team. The regulatory deadlines are approaching faster than most institutions realize. Here's what I want to know from you. Which of these three threats concerns you most? Beneficial ownership chaos, AI powered attacks, or the identity verification crisis? Drop your answer in the comments. I'll create a deep dive video on whatever you vote for. Until next time, stay ahead of the curve.